other than a few spells. So maybe that's why we should be that when we're doing building better portfolios, maybe we need to think about downside risk, because maybe that comes when we least expect it. I'm on here saying, the unemployment rate's still going to be in the 4s. What do I know? Like, what if it goes up to 10
No, it is
again?
the importance of protecting portfolios. I think many of us have lost sight of that. None of us on this podcast, of course.
Of course.
But broadly speaking, we've had the Fed put, we've had easy monetary support. We get bailed out left and right whenever we need it. Welcome back, everyone, to the latest episode of Building Better Portfolios. As usual, I am your co-host, Paisley Nardini, joined by Josh Flade. And it has been a super interesting year thus far. And we are joined today by Jeff Weniger, who is the head of equity strategy at WisdomTree. And a couple weeks or months ago, when we first reached out to Jeff, we had joked about scheduling this podcast several weeks out. And Jeff essentially said, hey, tumultuous markets makes for a really fun podcast. So if any of you are upset about the performance in the market year to date, you can blame Jeff. He wished this upon us. But all kidding aside, we are going to talk about what's going on in equity markets. What does it mean for portfolios? And ultimately where Jeff is seeing opportunity and maybe risks in the weeks and months ahead. So Jeff, thank you for joining us. Really excited to have you. And Jeff and I actually got to sit on a panel together at NASDAQ. I think it's been about a little over a year ago. So I've been super impressed by Jeff, his thought leadership. He is everywhere doing media. So make sure you follow him on LinkedIn if you want the latest and the greatest. But Jeff, thanks for joining us today. My
pleasure. The latest and the greatest, or the latest and the worst, depending on how good the market calls are.
Love that. Yeah, exactly. Nobody knows what's going on now. We're all just like, what is it? Surviving, not thriving?
We are, well, it depends on what positions you have on. I mean, I'd say in the first few months of the year, there have been some people who have been doing the opposite of surviving. I mean, people are loaded in software. I mean, if you go on the artist formerly known as Twitter, which we now call X, I mean, a lot of people got absolutely clocked. And then you're looking at portfolios and you're saying, well, regular old people who don't look at things, just they have a 60-40 and a 401k, they're not having a bad year. So it really depends. I think sometimes you get three of us, we're sitting here looking at markets all the time, and you get a little bit of a jaundiced perspective on the real action. But so far, it's really not half bad of a year. I mean, big asterisk on what's going on in the crude oil markets, but satisfactory 2026 so far.
I like that. You're a glass half full kind of guy.
Depends on the metric.
I was going to mention, we should probably say that we're recording this on the 13th of March for context, in case anybody listening in. Yeah.
We could be in World War III by the time this episode drops. So take all this with a grain of salt. No, I appreciate that, Josh. So Jeff, before we dive in to talk markets,
sure.
Let our listeners know a little bit more about you. You've been at WisdomTree for almost a decade, but you have much more depth of experience than that. So tell us who you are and what you've been doing.
Sure. And it has been almost a decade. And that means I've only really had two big boy jobs. I'm just this weird person who spends a decade at a firm and I go to another firm for another decade. So the one before that was 12 years. I was at BMO, Bank of Montreal, out of Chicago, actually, American, working for the Canadian bank for all those years. And then, came over. So I've had, other than my prior jobs, refereeing soccer as a teenager and waiting tables and all these various things I did, basically 20 years in the business at two firms. I really like WisdomTree. Awesome. It's a good ETF house. It's got a big, broad lineup of funds. They give me carte blanche to basically go anywhere and study anything I want to do and come up with interesting takes on the market, I guess you could say. So it's been a fun 9 years.
That's awesome. So one question we'd love to ask our guests before we get into the weeds of the topic at hand is just to help our audience get to know you a little bit better, perhaps. Is there anything in particular that most people, like peers, colleagues of yours, don't know about you that's an interesting topic?
That we could say
that we can talk about on this podcast.
Things that Well, I mean, I think maybe colleagues or people who are reading the research that they don't, maybe something along the lines of what does the day-to-day look like? And I think there's a view that you're sitting there necessarily watching the tape all day long. And you find that you see that when you're reading through the articles, that type of thing is, so and so beat the street today. I don't know that. It wasn't really that important to me. Now, I mean, to the extent that you're talking about a Mag 7 or something, you do take a look and you wait, Microsoft is going to report today, and you make sure you follow that. But generally speaking, there's a lot of times where people might get in touch with somebody at 3 or 4 in the afternoon. I didn't look at the market yet. Why do
Isn't that crazy? I feel the same way.
But and basically, like, well, why should you? Why should you be looking at the market all day long? You're doing research. You are theoretically trying to find ideas and theses that would play out over 12, 24 months. And if you do that, you're just going to get that goldfish attention span. I've seen it. I've seen it with people. It's just, you're going to end up getting whipsawed. You're going to be bullish on Tuesday, bearish on Wednesday, bullish on Thursday. And so sometimes that's a concept that's lost on people. And it'll happen a lot, when you're out there doing road shows or something, and you have a presentation, it's at a lunch, it's noon, and you have your deck, and you're presenting off the deck, and you say, well, what about this morning, such and such, we sold off such and such. I don't know that. I haven't even looked at the market yet today. So maybe that's the answer. The thing that I know that people don't know anything about us as strategists.
Yeah, no, that resonates, I think, with a lot of us, and even some of our listeners, especially those that might be financial advisors. Yeah. They're on the phone all day long with clients, and they're not paying attention to if the S&P is up or down 30 bips or if the 10 years up or down. And I get so into the weeds sometimes on a day-to-day, like I know exactly what's going on and the difference between Brent and WTI crude, right? But I don't know where the 10 years at. So that's a great point. So let's just dive right in then. As head of equity strategy, you obviously have a pulse on equity markets broadly, and more than just equity markets, of course, but through the lens of equities, like what is the state of the market right now? And as Josh mentioned, we're recording this in mid-March of 2026. There's a lot of noise. There always is. There's a lot of uncertainty. There's been a bit of a rotation trade this year within equities. Yeah. So like, what's your pulse on the markets? And then we can kind of take this in some different directions.
Sure. In terms of general market health, you could say that this increase in breadth that we've had is a very good thing. Now, you kind of pinpoint February 28th as a point where some things started to materially deteriorate. But if you look at a trailing 1 year across, let's say, the GICS level 1 sectors, to get really jargony with you guys, over the last year or so, basically everything is in the black. Now, there's been some breakdowns. Mag 7 is ice cold. The NASDAQ, at this point now, we're 6 months deep or thereabouts on the NASDAQ peaking out. It's October 29th. So you don't want to see.
What are we at from like a drawdown perspective right now?
On the NASI, like 7 or 8% maybe would be my guess.
That's not too bad.
Yeah, I mean, but now you have things that are correlating to that. Bitcoin called 120K at the peak, down to something like 63K, hyper correlated with the NASDAQ. And so that's not something that you want to see, because that's really a beta trade. Now that last couple of weeks rebounded about 10,000 points. So that's been satisfactory in terms of just general risk on concepts. Just thinking out loud about market breadth, things working, where my mind is going on various concepts. The S&P 500 equal weight, everybody's been talking about that doing much better than the cap weighted. So that's a good thing. Like, you want the S&P 493, or as we sometimes joke, the Russell 2993 to break up the Russell like 3000. You could steal that, Paisley. Just take it.
I will, yeah. Trademark that, Josh.
And then, materials have been kind of cold in last few weeks. But I had been saying for a while that if you were back on reflation concepts, that might be on, because energy and materials were signaling that to us. I don't know how much we're up on energy year to date. It's like 28, something like that, inside the S&P 500. But the area of concern I have for that, and some stuff's been percolating just in the last week or so, and we can talk about it as well. Do you really want to see energy and materials as your two best sectors? That's usually one of those things that's good until it's not. That has vibes of 2007 into 2008. People may recall the crude oil price continued to rally into the summer of 08, which seems like it's risk on, and Chinese economy. Yeah.
My take is like we don't want energy sector to be the leader unless we're creating jobs. And we're not creating jobs, we're losing jobs. So like the impact that has on consumers, I feel like is where this meets.
You feeling bad about the labor market here?
Sorry, go ahead, Josh.
Paisley,
I was going to say I think classic kind of end of cycle, you tend to see commodities rally pretty well. And so going back to your point, Jeff, not saying that I think this is the end of a cycle. I don't think it is, but there are symptoms of that. And then as far as employment, and Paisley, you can jump in as well, but I mean, it's kind of a mixed bag. I feel like you had worse than expected this last month. January had better than expected. I think underlying, you're not seeing a lot of problems, like just looking at, the data comes out every single Thursday as and I guess there's a question like, how accurate is this data? But if looking at initial jobless claims, looking at continued jobless claims, like it doesn't seem like things are getting much worse.
And we seem to be having more revisions to the downside as well. And I think a lot of the focus is around the theme of AI, and AI is taking people's jobs. Right. I think it's more simple than that. And I think it's more tangible in the sense that if you're a business owner, there is so much uncertainty around policy and tariffs and taxes, immigration, supply chains, that as a business owner, you're just saying, you know what, like there's still talk of recession on the horizon. And if there's this uncertainty and all these other factors at play, like why would I want to bring on additional costs through hiring more people right now? So I feel like it's, there's not really a need. And then there's some seasonal impacts. Obviously some of the government shutdown impacts from the last couple months as well. But I don't know, Jeff, do you have thoughts on kind of the labor market and its impacts on some of the, maybe the sector rotation that we're seeing? This is a big topic.
The labor market. Okay. I'd have to, if I was to put myself on a bell curve on the labor market here, on a score of 0 to 99.9, but 99.9 is several standard deviations away from the norm. I mean, I'm out there in terms of it stabilizing and being satisfactory or okay.
Okay, tell us more.
Okay. So there's a few things. For one, we have never had a situation where a new technology did, in fact, end up having a long-term effect on new jobs. Now, I understand that this technology, which is sitting right here on all these other screens, could theoretically take all three of our jobs. But the jury is still out, and the evidence is, for time immemorial, sample size, millions of new technologies, we've never had it become truly disruptive. Now, I mean, we all use LLMs all day long, and I mean, the tech truly is groundbreaking. But thus far, first digit on the unemployment rate remains a 4. And it's now we're starting to age into this a little bit. Like AI, I mean, when was the first ChatGPT hitting our desktops? I mean, it feels like it's like 2.5, 3 years ago at this point, something like that. And granted, you reach this point where and you can see it in your own AI usage. And we're doing it at WisdomTree. I mean, we have, especially with our young junior analysts, I mean, it's hand in hand. The entire workday is working with the AI. You're seeing it in index construction. But if anything, it's just making them that much more efficient, but there's no reason to get rid of people. So that's just the big philosophical point there. But then you also have some of these data points where you're saying, the narrative, I mean, I can fall in line with, I think, no hire, no fire, which is the key concept. I think I'm in line with street consensus on something like that. But if you look at, for example, like the Philly Fed survey just came out, we had been talking about this for several months. It printed like 3 3%, something like that, said decreasing jobs on the most recent. And I think that was the February. So look, we have to get the March numbers in. And the Iranian war commences February 28th. So things could deteriorate from here. But if you're thinking about January and February, I think the January print on that number might have been one of the lowest on records for the answer of decreasing employment. Then you have so one of the things I was looking at this week, you had the Manpower survey came out. I didn't know that it went back, the one where it's the employment survey where they have the 40,000 different firms. I didn't know it went all the way back to the beginning of COVID. But it's a quarterly one, and it's increased a couple quarters in a row, and it's at a 4-year high. And so...
And what is that survey telling, or what is it capturing?
Are you increasing or decreasing at your staff?
Okay, got it.
Yeah, and so that's one of those where you can't really get a time series on it out of Bloomberg, I don't think. But you can almost data dump that. The problem is it's quarterly. So when you're ever trying to do variable Y influencing variable X, it's difficult with these quarterlies. You can do it like on credit card delinquencies and that type of thing. But that one's ticking up as well. And so then you start to think about, okay, well, oil shocks with labor market deterioration. And you brought up that very good point there, Paisley, because this is an oil shock now. And if those two do go hand in hand, then I'm assuming you guys are probably roughly, you guys both look younger than me. You look material.
We're super young. We're in our 20s, Jeff.
20. But, I'm going to guess that the three of us, it's the global financial crisis is the sticking point in our minds psychologically. For me, to some extent, it's .com as well, but who knows, one of those two. And it's labor market losses with the oil shock is 2008. We always point out that one. People think of housing and subprime, but they forget that we had an oil shock in there, which was really what broke your back. If you were one of those people, well, I didn't buy a condo in Coral Springs to speculate. I just held my job, 40, 50 years old, whatever somebody might have been. I held my job. I didn't get any raise. I kept my head down and just made sure I remained employed. I didn't buy or sell my house because I was living in, Columbus, Ohio. I wasn't speculating, whatever it might have been. And the thing that person remembers from 07, 08 is gasoline prices. And so we need to think about that from that perspective. I've got a whole bunch of views on whether or not this oil shock is severe. I think it's not, but we'll see if we go down that path.
So that's a good read. And I appreciate some of the maybe not contrarian, but more, like you said, perhaps it's more consensus that maybe employment isn't, falling out of bed. And I think if we go back a few months, we felt pretty good about where we sat. And maybe this will now lean in towards thinking about more equity perspective, thinking about earnings. Earnings have been quite strong for the last few years. So from more of a bottoms up fundamental perspective, as you think about opportunities within the equity markets, are the earnings starting to flash concern? Obviously, AI is popping up everywhere.
Right.
I'm sure we'll see in some certain sectors the impact of oil prices from this quarter when we get first quarter earnings in a month or so. But what's the read on earnings and what's it telling us from a fundamental perspective?
Yeah, I think first quarter earnings came in at was it 12 year over year? It was something in the double digits on first quarter, excuse me, last quarter's earnings. I apologize. Yep. And so street consensus is going to be double. The thing about street consensus being double digits for calendar 26 is it's always that. And so we'll see how much it revises down. If you look a lot, it's almost like anecdotally, but if you look across a lot of the software names, they were still reporting increased revenue. And in many cases, increased earnings. It's the AI scare for down the road. So software is just one of those things where it really hasn't started to affect some of these business models. We've talked, one of the examples that I oftentimes hear WisdomTree people use is with CRM. Can you just build that? Can you just vibe code that into existence at your firm? And it's probably not something you can immediately do. Now, if you think about that sector, it was the software eating the world concept for so many years. that maybe it needed that nasty correction. And if you do the S&P 500 software relative to the S&P 500, I know you asked about earnings, and now I'm talking about software specifically. That did on these 30 and 40-year charts, and this goes back to not looking at stuff day to day. Pull up your 30 and 40-year charts, which is the way to think about markets. It far exceeded on the 500 software relative to the 500, far exceeded .com, and then pulled all the way, well, let's say pulled down. I mean, it's tanked down to the .com peak and then stabilized in the last few weeks. So that's something that's kind of intriguing, but I think it's testament to just how bifurcated this market is. People who are in the forgotten areas of the market from last year, like energy, they're kicking butt. Latin American stocks are doing well. There has been this broadening out in terms of participation. People in small caps are doing fine. And earnings, as you referenced there, I mean, they haven't started to deteriorate at all. Those are all very, very bullish portents. I mean, the thing that I would say gets me most concerned about the rotation, and if you're just thinking about the growth to value rotation, to some extent the large to small rotation, is, I mean, private credit is right here on the front page. And if you look at like the XLF, which is the financials from State Street, that's looking kind of ugly here. Financials tends to populate a lot of the value indexes. You don't want to see, just reading the mind of the market, you know, you don't want to see financial sector being your worst performer over, I don't know, what do you think, Paisley, 30 or 60 days, something like that. So that's something that's disconcerting. You know, you're starting to see utilities performing a little bit better than some other groups. You don't really want to see that as well. But generally speaking, if you're thinking about the reasons right now, if we make believe that private credit headline is not dominating the discourse, which is a real hard ask. But if the number one reason to be bearish equities right now is the oil shock, right, and the effect that would have on earnings, I think that we might be overestimating the importance of that. And I think we might be also psychologically anchoring to, let's say the crude oil, let's say West Texas Intermediate materially goes above $100 and stays there. The psychology of that might be very different from the actual effect of that, simply because $100 is not what $100 once was. And I keep coming back to that, where it's like $4 gasoline or $5 gasoline. It sounds like a very, very big scare number to me, but it's not what it once was. And that has to do with just the efficiency of fuel economy, the energy intensity of our civilization, and so forth. So we'll see if we go down that path.
Yeah. My takeaway from that is like, wait, there's $4 gas somewhere. I live in California, right? So it's like, we're almost about to see a 6 handle here. But I think your point is more of the behavioral reaction and the impact that has on markets. And I was talking with someone about this the other day, is if there's anything in this world that's constantly in your face every single day from a price perspective, besides us looking at CNBC or Bloomberg, it's us in a car driving and the gasoline prices at every gas station. It's a rolling, essentially, temperature check on like where we are. And the minute you see a, $3 to $4 to $5, like psychologically speaking, that has ramifications on how we spend money as consumers. One thing I wanted to ask before I forget is thinking about some of the rotation that we've seen year to date. And this isn't my own thought, I actually read this somewhere, is thinking about how investors came into this year and kind of bifurcating in the markets of long duration equities versus short duration equities. And that kind of explains, from a cash flow perspective, the uncertainty in the market and investors wanting things that have maybe stronger pricing power and higher dividends and more of the near-term cash flow, which is some of these legacy sectors, i.e. it is not technology. It's not those longer duration cash flow stocks. So how much, at least, have you done research on this that helps explain some of this rotation and why we might see some of these unloved sectors being represented now?
Yeah, and then the big question with that is whether or not it's on the short end or the longer end that tends to influence these things. We come across it a lot with small versus large whether or not Jay Powell into Kevin Warsh will affect this. The theory being, well, think about it. Like if you're a large cap company, you might be easily coming to market and getting 20 or 30-year paper. But whereas a small company needs a floating rate bank loan, and then so the extent that Kevin Warsh comes to the rescue or does not, then it would benefit smalls or discourage smalls, depending on whether or not he's favorable accordingly. Now, the other thing that's going on here is in very tame fashion, and it's critical to note that it's happening in tame fashion. The 10-year, which Paisley and I do not check every single day because that would be foolhardy, the 10-year has gently backed up. I haven't checked it today, guys. Is it like 4.25? Something like
I think it's like 4.15 today or something.
Okay.
But
and we were at like,
maybe I did check. Maybe I lied to you.
Maybe she did. And it was at like 395 just a few weeks ago. We backed up on the Iranian crisis. Now that is something that, generally speaking, I mean, it's very small moves, but that would be a hindrance to stocks, right? Because there's an opportunity cost of asset A, of not owning asset A relative to asset B. But if you think about the bond market in the here and now relative to prior eras, and we'll see if that ends up playing out. But in the 2022 situation, this was a lot of what we were talking about, was there was a decimation in the old FANGs, which some of them graduated to become the Mag 7. Others just became regular stocks like Netflix. Like Netflix just stopped being, it was a FANG. And then it's like, forget it, Netflix. You're no longer in the club.
Netflix is trying to roll solo. And for those of you listening that are not familiar with the FANG stocks, I feel like we're dating ourselves here.
Yeah.
I feel like the acronyms of this group of leaders continues to change, which is a good reminder to everybody that what is happening currently will not happen into perpetuity. Like things evolve, things change. And the FANG to the Mag 7, and I think 4 other acronyms between that is a good example.
And if you think about the FANGs, the individual letters, half of them now represent what the company used to be named. So the F was Facebook. So it's Facebook, Alphabet, Amazon, Netflix, and Google, which is also now renamed. And if you think about the 22 action, you had the bond market selling off. I think that was the worst year on record for the bond market. If I'm not, I don't know how much.
2022.
Yeah, I don't know how much.
Yeah, 2022.
It was nasty. Yeah. And then they took out the FANGs, and they took out tech, and they took out a lot of the stay-at-home trades. And I mean, there was a lot of stuff. You had the meme stocks were just absolutely hammered. The SPACs, NFTs, all that stuff. It was a speculative market giving way. Now, this is the question we pose out loud, and then we don't answer it because Paisley, Josh, you guys don't have the answer. I don't have the answer. Is how speculative was the vibe of 2025 relative to the vibe of 2021? It was much less so, but that's a subjective assessment. Much less so. What does that even mean? And so if you think about a lot of the 2025 risk on concepts, they've been kind of cold here. There was, take for example, foreign currencies. That was a general risk on. They've been cold now. The dollar has caught a relief rally in a generally risk off tape with the VIX floating around here in the 20s. The bond market's starting to now. I mean, the bond market spent all of last year gently rallying. And now it's gently declining. And it's good news that it's gently doing it, because in 2022, that's when the MOVE index, and we can define terms. The MOVE is the volatility index for the bond market, for people who are watching that might not be living this like the three of us. The MOVE went spiking in 2022. And so you had nasty vol in bonds, nasty vol in stocks. And so there's some little parallels here in the tape. It doesn't mean that you have to lose money, because I don't think there was that much of a speculative endeavor in last year's action, but it just means that the market has an opinion. The market is telling us something, and it's telling us, I think, that a lot of the stuff that was working doesn't want to work anymore. And I think a lot of the trades that people got piled into are in a state of reversal.
Do you think some of this is going to be temporary in the sense that, I mean, if you look back over the last 10 years, I mean, growth has outperformed value.
Yeah.
I think there's a lot of structural things around that. Do you think that those structural things are going to change? Or do you think, yes, we might have this period of time where international outperforms US. We might have this short period of time where small cap outperforms large cap. We'll have a short period of time where we'll see value outperforming growth. But then once we get through this, then will it go back to what we saw before? I mean, what do you think?
The most brutal question. It gives me the most brutal one.
That's why Josh just sits
double
quietly
barreled
and then just waits to pounce.
The best way to evade that question is to ask what is growth and value, and then to hammer Standard & Poor's and MSCI. Because I mean, these indexes are constantly changing. The definitions change. So if you think, Josh,
Absolutely.
about like when we had going to 2022, watch how I evade this. See how I
It sounds like you're a pro. It sounds like you do a lot of media, Jeff.
I was going to say he does.
The old thing is you get asked a question, you answer the question you want to answer.
Exactly.
No,
yeah,
but
not your first rodeo.
I'm going to answer it. Maybe. If you go back, what happened was if you think about the January 3rd of 22 to October 14th of 22, that's the S&P 500's bear market. And then S&P rebound. That's slang. They rebalanced the 500 value and the 500 growth like they do it on December 12th or 13th or something. And so what happened, and I'm going to have to try to remember what names went into the value index went into the value index right at that period of time. And we're over at WisdomTree saying, okay, we have these dividend weighted value indexes, we have the earnings weighted concepts. And then suddenly I think Facebook did a flip. The old Facebook went.
It did. Yeah, I remember
and
that.
Somebody else did too. And I want to say it was was it Amazon? There was
I don't recall.
But
like two that you're like, those are growthies.
Those are growthies. Those are hot business model stocks, and they end up in value indexes. So that's the first part of the evasion of your question, Josh. The staple answer that I think I can give here is that we have had this massive divergence between growth and value. It's been more than just 10 years. I mean, you can basically, let's date this all the way back to the global financial crisis, notwithstanding a year here or a year there. So you might be 17 years deep into it. Now, you don't want to measure these things by the clock. We never want to measure bull and bear markets by the clock. But if you want to put the beginning of the 1990s growth cycle on, you can usually, depending on which index you're looking at, it's like 1993. So you're something like 1993 to 2000. So you can measure that as being 7 years in its length. The counterpoint that nobody ever gives, which is good, but this is what I would give because I tend to be a value investor, is that value really was just kicking growth's butt in the 60s and the 70s and the 80s. And so maybe we were just so lopsided on some of these. Now, the other concept that you point out was small versus large. That's going to be an interesting one because the side note here, the asterisk on it is that for our careers, if we say that private equity as we know it, I mean, and what's the start date on that? Because private equity has been around for 40 years or so, but as we know it in a level of sophistication and size and scale, 15 or 20 years. And so one of the things that I will oftentimes point out when we're trying to win business in small caps, that type of thing, is, hey, look, small caps, when you're doing like a Russell 2 relative to the Russell 1 or what have you, they are showing up something like 30% cheap. And they've been stabilizing here at 30% cheap to large caps the last 3 or 4 years on these long-term charts where they were oftentimes sometimes at premiums. The point that I will oftentimes make is know what you own, because maybe they're cheap for a reason, in that the private equity houses why have they not come in and bought one of these companies in the 2000s? Like maybe it was because they didn't like the business model, or maybe it's something they've already gotten all the good candy and we're left with the bottom of the Halloween bag where it's just the apple somebody gave you and with the candy corn. Nobody ever wants the candy corn, that type of thing. And all the Snickers bars.
I'll take the candy corn.
You like that?
I have weird tasting candy. I like Charleston Chews. I like Three Musketeers. So I'm good to hang. Like, you can take my Reese's all day long.
That one's my
Disgusting.
favorite. That was my favorite is the Reese's. So go figure. Now, the coolest part of your question, I think, Josh, for 26 is the part about the foreign equities, because that one is fascinating in that, is it market valuations or is it, I totally missed this, I need to spend 2026 catching up. And so this is where, and Paisley, you probably have almost the exact same experience as me on this one, where you don't have a data point. You're just in a lot of conversations about markets with advisors, and you know their pain points, and you start to create data in your mind from a series of a bunch of anecdotes. So I'll make the statement, and let's see if Paisley agrees. Generally, in 2025, like at the beginning of 25, in our experience at WisdomTree, nobody wanted to talk international developed with us. Okay, nobody. Now, just to set that table, right now as things stand, now back then, let's say the MSCI All Country World was something like 60, heck, it might be like 68% US at the peak, something like that. So 68% of the global stock market was the US, and then 32, I'm back of the enveloping this, was everything else in developed plus emerging. Now it's like 62 is the US.
Mm-hmm.
But we watched it unfold as 2025 went on. The advisor community, many more successful flows coming in on the developed mandates. Much more so. It was kind of like a catch up. Like, oh man, I'm 90 or 95% US equities. I missed this. And you know what? Truth be told, that was a great call for like 15 years to be 90 or 95% US equity.
Absolutely.
And then catching up in 25. And I think we're still seeing some of that follow through. So I think that's the reason to be bullish in 26 on developed equities. But I mean, is that fair?
Yeah. So as it relates to international equities, and this is true many asset classes, because we're all behavioral, we're all human, we're all, right, have emotions tied to us, whether we like to admit it or not, is that I guarantee you the allocator space investors, it's like, if you liked international equities at 14 times, you're going to love them at 20 times, which is the exact opposite, right? That's the exact opposite of like buy low, sell high.
Yeah.
But people want to see traction. People want to see momentum in these asset classes before they jump in. And that's exactly what we saw. At 14 times earnings, international developed equities, people were like, not interested because of the reasons you just mentioned, Jeff. Historical biases. The US has dominated for 15 plus years. But all of a sudden at 20 times, now all of a sudden this is looking attractive.
Yeah.
You've already missed out on some of that run up. And then unfortunately, to your point, is then allocators say, well, I've missed the run up. There's no sense in doing this now. And then all of a sudden they're at 24 times. I'm just throwing out random numbers here. But unfortunately, from a behavioral perspective, like that's how markets tend to work.
Yeah. And sometimes through my career, I've seen it. I mean, this goes back to the old, the BMO days. I remember we would have American clients that just happened to be clients of a Canadian bank, Americans living in Chicago or living in Phoenix, asking, this is during the commodity super cycle, asking for Canadian dollar bank accounts. It's like, well, you don't go to Toronto. You don't go to Vancouver. Why? This would be the equivalent of me right now. I'm an American. I live in the United States. Like, why would I want a bank account right now in Swiss francs? Just to take a risk off currency in contrast to a risk on currency like CAD. It wouldn't make any sense for the Weniger family to do such a thing. But you get it in the 9th inning of a cycle. People wanted Aussie dollar bank accounts. What do you tell me? You live in Phoenix. It's like, but we would get that type of thing. And
sounds a little suspicious, actually.
No, if it was in Swiss francs, it might be a little bit more. Well, at any
yeah.
So we're thinking about And so you start to, when you get so far away from the last time a cycle worked, the forgotten memories get there. So let's take that, the 24 handle, which, wow, can you imagine MSCI EFA 24 times if this keeps going like this? It's forgotten that at this point, it's now 19 years ago. Forgotten memories. This is back in 07 when MSCI EFA, which is the industry's widely used index for developed equities. I'm just explaining terms here. I know that you guys know. It was at a premium to the S&P 500 for a brief spell there at the end of a cycle that was going from 2000 to 2007, where everything that was not the US was handily outperforming the US, basically from the end of .com into the credit crunch. And then it's also, this now dates the three of us. It's just whether or not you're doing market history. And it's on account of Japan specifically. It's just such ancient history that basically developed equities from good chunks of the 1970s, but definitely during the 1980s, the entirety of the 1980s, on account of the Japanese stock market, just crushed US stocks. And you get to these points where you do the coming back from meetings, where you hear something like, I remember a few years ago, somebody said, value can never beat growth. And you start.
You're like, I'm going to go buy a bunch of value now.
Yeah. And
that's how we know we're at the top in the growth market.
and you started to like into 2024 and even last year, it's things like, I've been burned in foreign equities. They can never beat the US. And you hear that type of stuff and you can't really blame people because it's, they've tried it, they've taken a stab and they keep getting burned. But you start to hear that stuff where all market memory has been so past tense, where you have to go back to 2007 to the last time that topped out. And people just simply forget that is it 2025 and 2026? Or is it 2025, 26, 27, 28, 29, 30 that you're sitting here watching, just throw a dart, German equities, the DAX, kicking the S&P 500's butt? Flip a coin for me. But there's a lot of people who can't even get their minds wrapped around such a concept. That might be the reason to be bullish, just to pick it, German equities.
Yeah, no, I think that's a great point. And if we go back to kind of the premise of our podcast here, building better portfolios, the power of diversification. And I think everybody's always so honed in on how do I maximize my return? How do I chase all these strong returns to be the highest performing portfolio? But if it's causing you angst and anxiety and you feel like you're, underperforming for your clients because you're all concentrated, that just the power of diversification so that you can sleep at night and that that like none of us have that crystal ball. So how can we think about building a portfolio that can take advantage of the uncertainty in markets without missing opportunities that you've mentioned? So I think that's really important.
Yeah. And I mean, one of the things that we oftentimes feel because of the nature of the way we run money at WisdomTree and the asset base is, okay, so we're talking about German equities, British equities, Japanese equities, whatever the case may be, or big baskets that they're in. What do you do with the currency? Do you own? I mean, so I would say, again, this is just like anecdata. 90% of the people would say, well, just own the currencies and don't hedge it back, right? That would be in their mind. One of the diversification benefits is that, you don't know where the dollar is going to go. And I don't know where the dollar is going to go either. But we've oftentimes said, hedge it back. And then what you end up with, if you look now, because there's now a lot of concepts, a lot of indexes that have multi-decade records, you start to show up a lot of vol metrics nicely on the currency hedging side. And so you could, if just to take micro data and think about this, this situation we have where, and it's funky because the dollar has been generally rallying while the crude oil price that likes dollar weakness has also been rallying. So just explode your head right there.
It's kind of like gold and equities going up together as well. The rules are off the table.
Rules are off the table. You think about gold's action in 24, where the dollar rallied and gold also had a nice 2024. That, if you would have told me that when I was getting into this stuff at the turn of the century, that would have been a head exploder right there. But If you think about recency bias, last few weeks of action. All right. So in the last few weeks, I know one of those sessions, the VIX hit 28. Maybe it was on February 28th. Because I remember thinking, oh, it's once the VIX gets to 30, that's when I bring all my VIX charts out and float them all over Twitter, because that's when you need to get contrarian long. 30 is like my threshold for publishing all the VIX stuff.
Yeah.
VIX hit 28. Bond market not doing well, not doing horribly, but bond market refused to rally off of a risk off. The S&P, let's say Paisley was mid-January. We briefly touched above 7,000-ish on the S&P. And then in recent tape, I don't know where we are today, but we're like in the 66s and now we're in the 67s. So there's not any big problems here, but generally risk off. They took out Korea and Japan, because those were the big melt-ups. Korea had been up 40% for the first 2 months year to date. So they took out a lot of stuff. And now you have this pie chart, this asset allocation pie chart, X% US equities, X% developed, X% emerging. And the dollar caught a bid. The dollar rallied. And usually, go back to those Swiss franc. When it's risk off, we go for dollars and we go for Swiss francs. That's what we do. And so to the extent that you are in euros or you're in Euro Stock 600, whether, you're at some mutual fund house, what happens, whatever you may have, to the extent that you were in those European stocks and hedge that back to USD, you saved some hide here in this risk off episode. So what we tend to find, just thinking from an asset allocation perspective, is that the unhedged ones tend to make more money in the bull trends. But you find out about it when you have a risk off. And so the vol metrics, and I wonder whether it's just, we call this a 16 or 17 year bull market. We've had a couple risk off periods. There's the COVID crash, there's the 2022 action, but both of those pale in comparison to the .com 2.5 years and the October of 07 to March of 09 episodes, 1.5 years. Do we, and this is like, when I say we do, I mean like the three of us, like people in the industry, other than a few spells. So maybe that's why we should be, that when we're building better portfolios, maybe we need to think about downside risk, because maybe that comes when we least expect it. I'm on here saying, the unemployment rate's still going to be in the 4s. What do I know? Like, what if it goes up to 10
No, it is
again?
the importance of protecting portfolios. I think many of us have lost sight of that. None of us on this podcast, of course. But broadly speaking, we've had the Fed put, we've had easy monetary support. We get bailed out left and right whenever we need it. And so that's typically when people are caught off sides, is when we have these kind of catastrophic events in markets. So protect your portfolio, diversify your risks. So yeah, I think we're running out of time with you today, Jeff. So appreciate all of your comments. But Josh, I'll let you take us home.
Yeah, no, I'll just end it with that. I think this is a great conversation and a good reminder about the thoughtfulness that goes on between people like us in the industry that are thinking about these things as we painstakingly build portfolios and make allocations and make these calls. And I, Paisley, you had mentioned that none of us have crystal balls, but I do think all of us do the best that we can, which is I think the most important thing, is that we're intellectually honest. We have these conversations, and then we build these portfolios with the idea of risk, not just return, in mind. So Jeff, thank you for joining us.
My pleasure.
And we'll definitely have to have you again. This was an awesome conversation.
Cool. It was great. Thanks, guys.
The views and opinions expressed on this podcast are those of the host and do not reflect the views, opinions, or policies of any current or former employer, affiliated firm, or client. The content is provided for informational and entertainment purposes only and should not be considered investment, legal, or tax advice. Nothing discussed constitutes a recommendation to buy or sell any securities or investment products. Listeners should conduct their own research or consult with a qualified professional before making any financial decisions. The hosts are speaking solely in their personal capacities, and the podcast is not affiliated with, sponsored by, or endorsed by any firm or organization with which they may be associated.